how do you see going to kind of the spending? How do you see Social Security, meaningful, substantial Social Security cuts or Medicare cuts in that climate?
Well, I mean, I think what you have to deal with is what Asteroid will bring up again and again, which is correct. You have to understand what the carrots are going to be. We've seen a ton of sticks, right? We've seen we're going to cut this, we're going to do this, we're going to eliminate this. Basically, tariffs, right? Tariffs are a tax. We're going to engage in all this austerity. And the question is okay, what comes along that's good? What's the gimme out there? Because, yeah, I mean, it's important to secure the borders. It's important to get illegal immigrants out of the country. It's important to do all these things on the fiscal side. But it's also important to, tell the people, here's what you're going to get in exchange for the haircut. And I don't think we've seen that yet, and I'm curious what that looks like. I mean, I'm skeptical whether they can even get the tax cuts through. Elon says he thinks he can get to 60 in the Senate. We'll see if that's true. I mean, Elon says a lot of things. But the point is, you need to give some people something positive in the form of a tax cut or work on the income tax, something that is going to offset what I think is going to be some short-term pain in asset prices. Because, let's be honest, what has held up consumption for the last 2 years, what juiced the economy and kept it together, probably from flipping into recession under Yellen and Biden, was a high asset price market, and that didn't help the bottom 60%. The top 30 or 40% that does the consumption, they were looking at back-to-back 20% plus years in gains. So it's very easy.
Top 10 is 60%.
You're right, but what I'm saying is that in terms of consumption, you're talking about.
Yeah.
I mean, we can dance around with the numbers, but the long and the short of it is, in a consumption economy, right, in a service-based economy, those people at the top end are actually driving the aggregate economic data. The data taken as a whole can be driven higher in the K-shaped economy by just that upper quartile, let's say, to be generous. And in an economy where asset prices start to decline, right, that can become a vicious cycle in the other direction very quickly. Unless you do tax cuts, unless you do some sort of, further corporate tax rate, you got to do something. Otherwise, that can get away from you pretty quick.
Joe, I got a question. I'm very curious what your opinion is. So, I was agreeing with you, by the way, about the top 10 driving consumer spending, but the propensity to spend of interest income is 70-80%, right? So if you're a wealthy person that gets an interest, you bought treasuries, right? And you get your interest check, you're going to spend on average 70 to 80% of that. Equity gains, it's more like 10, 15, if memory serves, 10 to 15% of that wealth you actually spend. So if interest rates are falling due to growth, how do you see that playing out?
Oh, that's not going to work. It's going to come back in a minute.
One of the reasons, again, that the fiscal dominance argument has worked is because high interest rates are stimulative. Interest rates in an elderly population of boomers who say, look,
literally, you should be able to grow a number $500 or $300 and sell off a fucking dollar and make profit. You know what I mean? Something's not fucking
they're sticking them in money markets and getting 5%. That's been a huge economy for the last couple of years. And that has
maybe
been
it's
free
2
cash
cents,
flow
but dude, it's
for all
something
those
for
folks.
fucking
They
for
don't
your
even
time.
need to take duration exposure risk.
Just
they
to
don't
put
need to
the
buy
bid
10
in.
years and worry about that. They can just stick in money markets and live and be fine. And once you pull away that punch bowl, once you pull away that spigot of 5% and it goes to 4%, and you have CPI still hovering roughly.
They're pulling away the spigot.
Threes,
He said the guy that makes all the money.
Right? That's just making it a little bit tougher.
He knows right now it's making money on him.
I understand how a lot of conservative circles, they're like, oh, well, nothing.
Appreciation still coming through.
And you get in Bitcoin circles, there's sort of a confused narrative in Bitcoin.
Think this will make it go down?
Oh, nothing stops this train, but we also want a balanced budget. We want fiscal prudence. Those things they don't make sense, right? Like pick what you want, be consistent. If you want fiscal discipline, know that asset prices will fall.
I don't want it to go down on
okay?
time.
That could be the price you have to pay for a more sensible for a budget for the train to stop. To paraphrase Linoleum.
Joe, I still remember when it was a relatively frequent occurrence on Bitcoin podcasts where you would hear people say the worst thing that could happen for Bitcoin price would be a return to austerity and having gold coming back into the banking system. Like, frequently, whenever people were asked, well, like, what could stop this train? People would say, oh, yes, austerity measures and
I told it I'm not selling, so it drops a bigger chunk.
Would really
like, I'm not
take the wind out of
selling.
Bitcoin sales. And now that at least the zeitgeist is moving in that direction, it's weird to me to still like turbo bullish. Obviously, I'm still here. I'm still a Bitcoin maximalist. I still think it's the right move for the future. But in the interim, the move in the direction of some amount of prudence when it comes to government spending, you should assume at least that it would be short-term, impactful in a negative way on the price continuing to rip. I just think it's interesting that that's kind of gone away.
You're totally right, and I'll just end with one thing here, okay? Like, if your goal, if you really want...
These guys notice the water spigot guy. Where the fuck is he?
$1 million.
He's got someone that comes in. He does. He knows how to make money come out of this thing, and they don't want to. Like, yeah, we don't want to look how the fuck he does it. Neither do I.
We should be responsible.
What the fuck did he do?
Get things in order. Okay, well, but you're also talking about $1 million Bitcoin in the next year. How do those two things jive?
Joe, can I throw out
info? Let's make her snappy because we try to.
They know this guy's the water. They trying to hold the water back.
Everybody on stage the chance to maybe give some closing remarks. Go ahead.
Okay. Yeah. So if asset prices fall, capital gains tax revenue falls. If the kind of spending that Doge is doing is not enough to kind of offset, say spending with automatic stabilizers, we enter a recession. Say spending just stays flat and doesn't increase, but revenues are falling because we're so hyper financialized and asset markets are falling. In a world where the deficit starts to become 10-15% of GDP, maybe even more, that is a world where you get a steepening yield curve and that kind of inflationary impulse, that liquidity impulse, that stimulatory impulse where growth slow get this huge kind of impulse of liquidity.
Hey, one quick thing, just to run these numbers, and you can do this yourself, and we'll save everybody's time. First of all, when you go into a recession, okay, and especially a disinflationary, deflationary recession, which is a really hard down from lack of government spending, look what happens to yields. Yields collapse. What is one of the single biggest drivers of the deficit? Interest rates. The interest rate picture. And I've run this model. You can run it yourself at GT. You can assume certain variables. There are situations where the automatic stabilizers actually do not result in a net gain if interest rates decline precipitously back down to the zero bound. You can run that on your own time, but that's the math. The math is that we actually can have a deficit decline given the automatic stabilizers in a recession if interest rates come back down to zero bound.
Do the math, people. Run the numbers.
I'm not buying anymore until this thing goes 99,000.
And
this gets sold by $17.
All right, two quick points or questions for Joe. One is the point about the yields. The theory that I'm hearing floated is that when Powell tries to drop short-term interest rates and the long-term rates keep going up, they're losing control, and it can be a situation where you've got to charge the interest rates you need to charge to move the product.
I know what he's saying. You got to buy it while it's cheap.
Then your interest rates are going up as the supply and demand issue.
I'm already.
So the rates are going up because they have to sell the bonds.
I'm not in high enough. Let's put it that way. I think is the thing.
Might there be a situation
I keep getting on the low end, and they're doing it on purpose.
Reduction price of assets, but a flight of capital.
It sounds crazy. My
so that it actually
everything I do is not the same thing you do. How could
the
it
second one's easy. You can always decouple. Let's see when the evidence comes, but right now it's not really the case. With respect to the first question, right?
Yeah, when the evidence comes, the money's just gonna fucking. It won't matter. I've seen when it turns green, dude. When my fucking unrealized return turns green, the game changes.